Hi everyone, welcome to another episode with Amateur Investor. Now, to kick things off, just to let everyone know who am I and what is the purpose of this channel. As the name suggests, I am an amateur investor. I will be going through the basics of investment. It's not in depth and you shouldn't be using this for your final analysis of whether to buy or sell shares. I'm here to share my lessons learned through countless YouTube videos. And just to let everyone know that I am a fundamental investor myself. What this channel is not is I am not a professional or licensed financial advisor. I am not giving full analysis on stocks. I'm also not giving recommendations on any stocks. Therefore, I'm not liable for any of the content that you might take away and use for your own investment. Common terms that you might hear in the investing world on shares for beginners. PE ratio. Essentially, a PE ratio is the price that you pay for a share versus the earnings of that company over the last 12 months. Dividend is a portion of the earnings that the company might pay you. Earnings per share, which is, as mentioned before, earnings from the company over the last period. Might be a quarter, might be longer. S&P 500, which is the top 500 shares in America. So that means if a company drops out of the 500, it will be replaced by a new company. Technical analysis. I'll go through that in a bit more detail later. Similarly, fundamental analysis, I'll go through that in more detail as well. Now, let's talk about S&P 500. Most of you would be familiar with companies such as Microsoft, Apple, Google, Nvidia recently. Less so, potentially, Bank of America, Novo Nordisk. However, these companies make up 500 top companies in the share market in the United States. You'll see some of them there. Now, I want to pause for a second and talk about ETFs. Common ETFs mirror the performance of the S&P 500. So it's a collection of the top 500 companies in the States, and their profits go towards the performance of the ETF. Now, the ETF can also look at value or growth companies. This session's not really talking about that. You'll also have ETFs that look at specific sectors like technology up here, consumer cyclical, communication services, and so on. So if you find a certain sector that you're more familiar with, there's bound to be an ETF out there. The S&P 500 performance over the last 25 years is charted here. At the turn of the century, the S&P 500 was 1,425. Recently, it reached 6,000. So in 2025, it did reach 6,000. On average, throughout the life of the S&P 500, you'll get annual returns of 10%. Now, I want to take a pause for a second and talk about dollar cost average. If these vertical dashed lines represent years, what dollar cost average means is at each year, if you invest $1,000, regardless of the price of the S&P 500 or the share that you're doing dollar cost average on, you will average out your cost of investment and your return should be an overall 10%, for example, for the S&P 500. Now, going away from dollar cost average, what I want to point out is over the last 25 years, the S&P 500 has actually returned over 400% from 2000 to 2025. That's actually 17% per annum. So your normal inflation, governments try to make inflation around about 2 or 3%. If you invest in the share market just on an ETF in the S&P 500, you would get 10% annual return overall for the life of the S&P 500. Or if you had invested in year 2000, you would receive a 17% per annum, which beats inflation. On a move and talk about technical analysis. Now, normally for charts, you'll see volume down here, which means the number of shares transacted during that day or that period. What you'll also normally see for technical analysis is moving averages. Normally people use 20-day, 50, and 200-day, which means the average over 20 days or 50 or 200. So the average price of the share over that period. Another component of technical analysis is people might buy at what's called higher highs, which means that if the share price is trending up and you see a higher high going up, 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 that means that people look at these trends and they might buy when it hits down here near the 20-day moving average. Conversely, some people might short shares and sell at the lower lows. We won't talk about shorting of shares here. Another thing that technical analysis looks at is resistance. So if I do draw two parallel lines, what I'll see is the share market, funnily enough, has a pattern where it hits the bottom line and then goes back up, bottom line and goes back up. Similarly, there's a resistance at the top here. See if you have a resistance point here, a resistance point close to here. Now, sometimes the resistance line is exceeded and then that becomes a new resistance line. As you see, it's actually hit the bottom of the candles here, bottom of the candles here. Now, when you combine the volume, moving averages, and resistance lines, you will actually see a combination of the patterns. What you might see, if I draw a different line, this is another resistance line. The candles try to exceed that resistance line. And what happens here is that the candles have actually popped up beyond this downward trending resistance line. So there's a potential that it might be an uptrend. Now, As we go along here, having a look day one, day two, day three, and so on and so forth. And what you see is the volume all of a sudden, when you see the 20-day and 50-day cross each other, then some technical analysis buyers might start to actually buy the shares then. That's where you'll see the volume go up. You've got the previous resistance line exceeded. You've got the new resistance line. So this could be a really good indication to start buying. Now, if you'd waited normally 1, 2, 3 days, you're pretty confident that it should actually go up. Now, if you'd actually done it a lot earlier, you might have actually missed out or read the graph wrong. Sometimes it pays to wait, potentially even wait for it to bounce off the 50-day. So potentially wait for it to bounce off the 50-day and then buy here somewhere. That is again a bit safer, but essentially that's how you combine different technical analysis methods using resistance, moving averages, and volume. I want to move on to fundamental analysis. PE ratio, which we've spoken about before, the price you pay versus the earnings. You got the dividend, part of the earnings that is actually rewarded to you for your investment, earnings per share, or how much the company earns over the last quarter or 12 months, and so on and so forth. Revenue, which is how much money goes in when the company produces products or services. Margin, we will talk about in a bit more detail later. Cash flow is something that's very important. Normally, I try and look at positive cash flows. Fundamental analysis is normally done by people, famous people like Warren Buffett. Howard Marks is another famous person in the investment circle. And Peter Lynch, who is now retired, built a fund that beat the S&P 500 performance by a fair bit when he was actually share trading and in charge of a fund. I want to move on to a screener. Now, a screener is, for example, I use Finviz. A screener is something that you can actually select different parts that you might want to have a look at for your fundamental analysis. You can click in Finviz under screener. You can go to the fundamental analysis tab. Here you'll see PE, earnings per share growth this year and past 5 years. Now, I don't go into earning per share growth next year and so on and so forth because I don't like predictions of the future. I look at recent performance growth and also over the last 5 years and see what the trend is and make my own fundamental analysis based off of those things. I'll also look at the sales growth the past 5 years and the sales growth quarter over quarter, which is more recent. Again, similar to earnings per share growth, I only look at the past and not what's projected for the future. There are other things that I also look at, return on assets and or return on investment, and I'll talk about that in a second. There's also gross margin and operating margin that I might look at as well. Let me know what type of fundamental analysis screens you choose for your investment. I might actually look at the insider transaction as well. Insider transaction, what that means is if I own the company, I might sell some shares. Now, there are various reasons that I might sell my shares. Not all have to do with bad performance of the company. Some of it might be, hey, I need a holiday and some money for the holiday. Now, for fundamental analysis, let's take for a second a lemonade stand run by Jill here. Return on assets. The asset could be the lemonade stand itself. Return on investment. Now, Jill has to invest in lemonades and water and so on and so forth. The difference between return on asset and return on investment. So return on asset is the profitability of a company when comparing its net income to its total assets, taking into account a company's debt. The difference in return on investment is that it measures an investment's profitability by comparing its gains to its costs. It, return on investment is calculated before debt. As long as you look at one or the other, it doesn't really matter for me. Now, sometimes you get, hopefully, customers, and you might have to employ people to help you produce more products or services. This comes under gross or operating margin. Gross margin is the percentage of revenue that is profit or how efficiently a company manages production cost. The difference between gross margin and operating margin measures how efficiently a company manages all costs, including fixed costs like rent and utilities. So hopefully that gives you a bit of an insight into return on assets, return on investment, gross and operating margin. So I would definitely say that at least have one of return on asset or return on investment, and again, one of gross margin or operating margin. Now, thanks for making it this far into the video. If you have, I'd appreciate if you like, share, and subscribe, and look forward to seeing you in the next episode.